RBI is less beholden to P2P than it is to the banking system.
Sure. Obviously.
So it will regulate much more harshly on a P2P player. And I believe at this point, a lot of P2P players simply have done the wrong kind of things. And offering guarantees, not showing customers like, so for instance, in a P2P network, you're supposed to be able to tell the customer this is who you've lent to. But what the P2P players is, give us 10,000 rupees and we'll only lend. We'll find the right borrower, and if they return money, we'll give it to a different set of borrowers and all that stuff. That's not how it's supposed to be done. It should be like P2P. I should know who I'm lending to. If anything changes, you need to tell me, and I need to make that decision if that thing needs to change or not. RBI is just going to make this a completely difficult proposition by saying, if you don't show people at every point in time who's borrowing, what is their credit score, and where they live, and how the recovery process is, and so on, then we won't allow you to operate this business. And now people will start getting random emails saying, because a lot of borrowers also, they're not of greatest credit, right? So they're just borrowing and lending off. So you suddenly find out your guys who have credit scores of, say, 400 or 500, which is very low, are getting your loans. What happens? And then their defaults, that changes the economic situation for P2P. I think P2P, at this point, it's a worse idea than lending to NBFCs. And NBFCs also, I think lending is not so much a problem. I mean, if you're buying into an NBFC bond or anything like that, but you have to be very careful of what kind of NBFC. Some of them will survive, some of them will not. So if you don't see their capital adequacy ratios today, and whatever it is today is going to go down tomorrow, because many of these P2P players, not P2P, so the NBFCs do have a portion of their book lent to personal loans, unsecured. So you're going to have that NBFC land in some kind of trouble. So if you forget buying their shares, but if you buy their bonds, you will still be in trouble, because even perceived notions in the financial industry can bring down a company. And if it's a small company, not very well capitalized, you will end up with trouble.
Yeah. No, thank you for touching on that, because ultimately, GRIP as a platform offers corporate bonds, and a lot of corporate bonds you offer are from NBFCs. The good thing is that all of them are investment grade. Most of them are A and above. But I think to your point, I think what we will try to make sure is that the information about capital adequacy becomes a very strong threshold for selection of corporate bonds on our platform, and also for investors to know what the capital adequacy ratio is before they invest. But Deepak, we have taken a lot of your time, just to round up the session with this question on corporate bonds, linking a few things together. You mentioned earlier that you do not expect bond yields to change much. You're not seeing cost of finance change much. This is something that will play out in the longer run. Do you have any other, most people were expecting bond yields to contract, right? Where we were in the interest rate cycle. This obviously is a very different development, may push up yields by a bit in the future. Any other advice that you're giving to bond investors at this point of time?
I think in general, you should expect bond spreads to widen. What I'm saying by that is the government bonds spreads bond yields may be X. Today, the difference between that and AAA is this much, AA is this much, A is this much. You expect a widening across the spectrum. We're going to say AAA getting 50 to 75 basis more than government. Right now, it's 10, 20 basis, that level. So you get 55 to, when you get 50 basis higher on AAA, and 150 higher on, say, AA and A, you're going to see that spreads widen across the board. Remember, here, when interest rates go up or yields go up, the A guy will easily become BBB.
Investments in debt securities are subject to risks. Read all the offer-related documents carefully.